What are some of your indicators of when it's time to let go of some of your silver equities? I mean, general indicators. Are you looking at a gold to silver ratio? Are you looking at fervor in the streets? What are some of your indicators? I would say fervor in the streets. I mean, understand that I'm not a trader per se. I construct very rough models around value, so price matters to me only as it differs from value. And the silver stocks that I had owned as a consequence of my belief in a move in the silver price music I have already sold. My reason to own the stock came and passed, and so I sold the stock. The reasons that I still own the rest of my silver portfolio is because I believe that there are circumstances individual to each company that will increase their value. So, as an example, I own Pan American Silver. The increase that we've seen in the silver price makes their acquisition of MAG Silver more economic than it would have appeared at the time that they made the acquisition. You know, that was an acquisition that was predicated on $35 silver. Yeah, $60 silver rewards them more than $35 silver did. In Pan American Silver, I'm also attracted to it music because they have now had, 5 or 6 quarters to begin to work their magic on the assets that they acquired from Yamona. And sure enough, they're beginning to get better operational performance at the same time that they're getting higher commodity prices. One could look at my holdings in the more speculative names V, less Silver, or Abra. In both cases, I think that there is a lot of exploration upside in the company. In other words, I don't own them purely for leverage to silver. I own them for reasons in interior, if you will, to the country company. Ironically, in a rip-roaring silver market, there's probably more money to be made on the juniors that don't actually have silver or the very inefficient producers. Because as sentiment comes into that market, you can take up $20 million market cap to $100 million market cap for no fundamental more specific than $500 financial public relations budget. That's not the way I trade. I'm very much a guy who invests, who buys and sells based on value or perceived value. And there's a lot of value and perceived value remaining in the high-quality silver names despite that parabolic silver chart. And an alarm bells in my head can't help but be going off. Is that misplaced, or am I accurate? I think it is misplaced, Steve. Okay, because only about 18% of silver supply comes from silver mines. The rest comes from recycling or as a byproduct of mining other materials like gold, copper, lead, and zinc. So to really get a feeling for what silver production looks like over the next 5 years, you have to pay attention to how much copper is going to get mined. And I think irrespective of what we do in the copper industry, we were going to have production declines in copper for the next 5 years music no matter what we do, which means that byproduct silver production is going to decline. Remember that as a copper miner, your production cost is effectively the cost of removing silver from the product stream. You have no mining cost because you paid for that in the gold in the gold account. A clear's throat, the zinc price has been up, but it's still fairly flat, and I don't see any production increases coming in copper or lead or zinc for the next 5 years. In copper, I think it's more likely that we produce less over 5 years music rather than more, and that should mean that byproduct silver supplies are lower, not higher, irrespective of the margin available on pure silver mines. When I look too at the silver mines on the horizon that could be brought into production, I don't see many. Certainly the exploration success that, as an example, First Majestic has enjoyed both downhole at Sandees, but also at Interetano, and the prospective joy that Panem sees at La Colorado. You don't see a new Cannington or a new Juanicipio. You don't see that much silver on the horizon. The two places that you do see silver on the horizon, one would be the Pan American deposit in Guatemala, the name of which escapes me, which appears to have still pretty strong political challenges ahead of it. The second would be another silver deposit within Pan American in Argentina, which is similarly, at least at the state level, politically challenged. So I don't see a lot of impending supply from silver music companies, and I don't see near-term supply increases, from byproduct, that is to say increases in the next 5 years, okay, because most of silver comes from copper mines. Comes as a byproduct, yeah, copper, lead, zinc, and gold. You are going to see some production increases on the gold side, which should give you some increased byproduct silver, but I would suspect not enough to be worried about. I understand your concern perfectly around the incredible margins in the silver business, where the silver industry would increase their production if they could. I just don't see them being able to in the near term. And it's important to recognize, as I say, that less than 20% of primary silver supply comes from silver mines. The intention of silver miners is less important than the intention of recyclers, who are pretty close to maxed out, and gold, copper, lead, music, and zinc producers. If you've been watching the silver market over the last year, you already know we've crossed the line between interesting and historic. This is no longer a matter of checking the price once in a while or wondering whether silver music might eventually catch up to gold. We are living through a structural repricing of the monetary metals. And while most of Wall Street music is still chewing on AI narratives or arguing about whether Bitcoin is a monetary asset music or just an overpriced tech stock with a chat room attached, the intelligent money, the institutions, the sovereigns, the industrial giants are positioning themselves exactly where they've always positioned themselves before a commodity bull goes vertical. They're standing for delivery. They're accumulating ounces, tons, and stakes in projects that are essential to the energy transition and the monetary unwind happening in plain sight. Let me begin by reassuring you that I'm not a trader obsessed with whether silver gained or lost 50 cents this morning. Price only matters to me in so music far as it diverges from value. And in the case of silver, we have one of the largest divergences between price and value I've seen in my 50-year career. When silver was $12 an ounce in 2020, it was cheap. At $25, it was cheap. At $50, it was cheap. And even at $60, when most retail investors suddenly get nosebleeds, music, it's still cheap relative to the forces that actually matter: supply constraints, industrial need, monetary policy, and geopolitical demand from nations that no longer trust the Western financial system. Music, you want indicators. Here are the best indicators I know. The smartest, best-informed people in the world are buying, and they're not selling when price dips. They're standing for delivery. They're forcing the Western system to cough up real metal. When you see 58 million ounces of silver stand for delivery in the first 12 days of a non-July month, when you see 8 million ounces of gold leave the system with barely a blink, you're not watching retail traders play games. You're watching sovereign wealth funds, central banks, and industrial consumers who know the playbook. They know what inflation looks like before it shows up in the CPI. They know what shortages look like before the Wall Street Journal is capable of spelling the word deficit. And they move first. For 36 years of my career, nobody stood for delivery. Less than 1% of futures contracts resulted in actual metal moving out of the warehouses. The system worked because nobody tested it. Music, it was all trust. It was all plumbing behind the walls of the financial system. Now suddenly that trust is gone, and delivery is becoming the norm rather than the exception. When you see industrial users, sovereigns, and ultra-high net, worth buyers ignoring the paper price and simply taking the bars out of the warehouses, that's when you know the story isn't speculation. It's structural, and if you want to talk about structure, let's talk about the structure of U.S. oil and gas, because what's happening, there is an instructional preview of what's happening in silver. The United States has drilled through more than 80% of its Tier 1 drilling locations. Music, that doesn't mean oil disappears. What it means is that the era of cheap, easy oil is gone. The Saudis know this. That's why they're holding back with 800 to a million barrels of spare capacity. Even while the price is low, they're not dumb. They know the world will come begging soon. Meanwhile, Mexico and Venezuela have production declines that even fairy tales couldn't reverse on short notice. You get the same story in the British North Sea. Sustaining capital has simply not been invested. You can't conjure barrels out of political speeches, and silver is in the same boat. Only 18% of global supply comes from primary silver mines. The rest comes from copper, lead, zinc, and gold operations. Now here's the kicker. Copper production is going down for the next 5 years, no matter what we do. That means silver supply goes down. And because no amount of price increase causes a copper miner to mine more copper just to get the silver byproduct, we end up with a unique problem. Silver's industrial demand is rising at the exact moment byproduct supply is weakening. Music industrial buyers have no substitutes. Macro thoughts on oil. The most important macro thought on the supply side is underinvestment in sustaining capital of between 1 and 2 billion a day. Producers around the world are not investing enough money in the oil production to maintain production 2 or 3 years out. $60 oil, and we're not at 60, we're below that. The United States has drilled through apparently 85% of its tier 1 drilling locations using current technology. Music, so at this oil price, I think it's fair to say that U.S. production has plateaued. Music, and it was the U.S. that was the difference between supply and demand. The Saudis have done a very good job of maintaining, sustaining capital investments. And it would appear now that the Saudis have between 800 and a million barrels of surplus producing capacity, which they could increase. But you have structural declines in Mexico and Venezuela, in particular, where declining, sustaining capital investments, music, have reduced their ability to produce. You also have what would appear to be systemic production declines in the music, British part of the North Sea sector. Again, politically induced. The wild card, of course, would be music, any peace announcement in Ukraine. If the Russians' music were permitted back into Western markets, well, it might not impact oil markets immediately because the Russians have deferred sustaining capital investments too. They will be slower to ramp up than people think. Music, it would immediately impact European natural gas markets. The ability of Russian natural gas to back out some LNG that's currently being shipped into European markets would impact global markets. But I suspect the real story that you're seeing in that price, a deterioration, has much less to do with supply and much music more to do with weakened demand. Weakened demand particularly in growth markets, or what were growth markets music, and in continental Europe, where I think the economy is much weaker than people think it is. That chart tells me that you are seeing a demand hiatus in continental Europe, and you're also seeing demand hiatus in China. I'm less inclined to believe that the unrest in Venezuela has anything to do with drugs, and more inclined to believe that it has more to do with oil. What are your thoughts? I think that's correct. If Mr. Trump wanted to solve the drug problem in the United States, he could begin six blocks from the White House. These people don't ship drugs into a vacuum. The right place to enforce drug laws on a global basis is the United States. That's politically very unpopular. The United States probably would like to influence the political will of Venezuela. Many people don't know this, but Venezuela has the largest probable reserves of any region in the world, including Saudi Arabia. The problem is that the Saudi crude is medium or light crude, and the Venezuelan crude is extremely heavy, extremely high sulfur crude. In order to upgrade, well, there's 2 kinds of crude in Venezuela. The Marbo crude, their traditional crude, is nice, light, music sweet crude. But they don't have much of it left, and they haven't made sustaining capital investments. The Orinoco crude is a heavy sour crude, and that's going to require real investment in beneficiation. Sidebar, What you're seeing in music, the silver market right now, is the kind of stress test that the comic system was never designed to endure. The futures market was always meant to settle music in cash with a tiny percentage of traders ever demanding metal. For 3.5 decades of my career, that's exactly how it worked. And now, out of nowhere, music month after month after month, tens of millions of ounces are standing for delivery. In just music, the first 12 days of December, most of which weren't even trading days. You had 58 million ounces of silver and nearly 3 million ounces of gold demanded for physical settlement. That's not hedge funds, that's not moms and pops, that's sovereign wealth funds, that's BRICS central banks. That's industrial buyers who have decided the only risk they music cannot take is the risk of not having the metal. In a market built on trust, the moment trust is questioned, everything music changes. The Western system has relied for years on the assumption that traders would roll their contracts, take cash, or unwind positions long before delivery became an issue. Now you have well-capitalized, politically influential buyers on the other side who are not rolling, not unwinding, and not playing the paper game anymore. They're taking bars. Music, and every ounce that leaves the registered category, every ounce that leaves the COMEX ecosystem, music, entirely is an ounce that will not be there when the next delivery month arrives. The warehouses are bleeding metal in a way we've never seen before, not even in 2011. And that to me speaks louder than any price action. The margin hikes are a perfect example of the desperation. When COMEX raises margins aggressively, they're not trying to cool price, they're trying to cool delivery pressure. Higher margins force out the leverage traders first, the weak hands. The intention is simple. Remove as many paper claims as possible faster than real metal leaves the warehouse. In most cycles, music, that strategy works beautifully. Weak longs are flushed out, the price collapses and the shorts cover into a quiet market, but this time it didn't work. Yes, you got a temporary shakeout, but the moment the weak hands were cleared, the market snapped back like a rubber band, and silver was up more than $2 the next trading day. Why? Because the buyers who matter aren't leveraged. They're not speculating for a nickel or a dime on the chart. Music, they're industrial users, sovereign actors, strategic accumulators. They don't care about daily volatility. They care about long-term access to a metal that keeps civilization functioning. You don't build missile systems, solar farms, satellite arrays, and high-efficiency electronics without silver. You don't expand 5G or electrify transportation without silver. These buyers aren't on margin. They don't blink when lease rates hit 7%. They're here for the ounces, and they have the cash to get them. This is what I mean when I say silver is behaving like a jifing good. When price rises, demand rises. That's not true for almost anything else in the world. When oil doubles, people look for alternatives. When wheat doubles, consumers cut back. But when silver doubles, industrial users keep consuming the same amount because they have no choice. When investors see silver rising, they buy more because they're afraid of missing the move. Inelastic industrial demand meets speculative, psychological demand meets declining byproduct supply. That's how you get revaluations, not trades, revaluations. And while all of this is happening, U.S. investment banks, the very same banks that spent years manipulating the market, are suddenly flipping from short to long. You can take that however you wish, but I'd suggest taking it seriously. According to the Economic Times report, J.P. Morgan now allegedly holds over 750 million ounces of physical silver. Music, if even half of that is correct, they possess the largest private silver hoard on Earth. They supposedly closed a 200 million ounce short position while simultaneously adding 21 million ounces of physical. That is not defensive behavior. That is aggressive accumulation, strategic, intentional, and aware. Music, then you have the 6 million ounces withdrawn from the registered category and taken completely out of the comic system. When metal leaves the building, it doesn't come back unless somebody voluntarily reassesses it and re-registers it, which almost nobody does. To take that much metal out is basically saying, we don't trust the system. We want this metal as far away from the COMEX delivery pool as possible. Even more revealing is the movement of 169 million ounces into non-deliverable vaults. These ounces technically still exist on paper, but have been legally removed from COMEX delivery eligibility. That's the subtle maneuvering of an institution that wants metal, not paper claims. They're safeguarding their supply. They're fronter running the panic. And if JP Morgan, the largest, most connected banker on the planet, is preparing for a world where physical silver matters more than paper, that should tell you something. This is why I laugh when people say silver is overbought. Overbought relative to what? Fiat currency that's being debased at a faster rate every quarter. Debt markets that require perpetual monetization to avoid collapse. Oil systems that are underinvested by $1 to $2 billion per day. Copper markets that will produce less for the next 5 years regardless of price. No, silver isn't overbought. It's being repriced. And when real assets get repriced after decades of distortion, the chart doesn't slope, it jumps. Psychology of the West still hinges on the myth that silver is simply an industrial metal with a hobbyist investor base. That's because the Western press covers silver only when something breaks. Meanwhile, in India, silver is being treated as a monetary asset again. Scrap silver isn't even coming back into the market because people prefer holding silver to holding rupees. In China, export licensing is restricting silver from leaving the country starting this year, and that restriction will tighten into 2027. China controlled the silver market for decades by supplying the West. That era is finished. Music they're now hoarding, not exporting. India is ramping up photovoltaic manufacturing at subsidies large enough to reshape global flows. Silver demand for solar alone is projected to hit record highs for the next 5 years, and anyone who thinks industrial users will voluntarily reduce consumption to save money doesn't understand the energy transition. A $1.15 iPhone does not get redesigned because silver goes from $1.25 to $1.60. A $40 million missile does not become obsolete because the silver load doubles. When the price of a crucial input is irrelevant to the final product, the demand curve becomes vertical. That's when shortages turn into crisis. Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today.